Let's take a look at a few of the charts in the Q4 2019 review article for Brave New Coin. As usual, everything is for educational purposes only and is not intended as financial advice. So this is the total crypto market cap going back as far as July 2017. And one thing we've noticed over the past 5 to 8 years is that crypto is highly reactionary to the intervals in the quarterly calendar. So it tends to react sort of in one sweeping motion within that quarter, down or up. It's really sort of binary generally. Ever since even January 2019, it's just been sideways up, massive up, down, down. So the question is always, as soon as it can be identified within a quarter, what is that quarter going to be? Because for the most part, it's decided and that's it. There's no wavering, there's no reversing, which was one reason why I was so concerned for the bullish perspective if this head and shoulders had actually panned out as a bearish reversal. It did not. Initially, it was projecting much lower lows for the total crypto market cap, which would have been certainly devastating for alts, devastating for BTC, devastating for the market as a whole, going back to the 3K level basically for BTC. There was also a bearish 5200 EMA cross, a death cross that occurred after the massive China news last quarter. Something else I was watching was the continuation of that from a bearish perspective. Starting this new quarter now in January, you can see we've started to pull up pretty significantly back to that 200-day moving average, which is the mean reversion point as well as the litmus test for trend. If we're below that, we're bearish. If we're above it, we're bullish. So this quarter, what I'd like to see, if I'm bullish, is a 5200 golden cross on the total crypto market cap. There's always a lot of question about alt season or not alt season, and in general, we've only had alt seasons when the BTC dominance, which is what this is, it's a percentage. So the BTC dominance, as long as it's above the 200-day EMA, alt season basically has never happened. You can see essentially back July 2018 was the last alt season we had. Within 2018 until July, there was a brief period where LTC, EOS, a few other alts moved in March before the Bitcoin's big move in April of 2019. But ever since then, Bitcoin has handedly been above this 200-day moving average, and the Bitcoin dominance has continued to grow. One thing that was illuminated very well last quarter was what the downward pressure, the selling was that initially wasn't known, especially to Western traders. So I'm referring to the plus token Ponzi scheme. Essentially, it started in 2018, went on through 2019, and what happened was Asian retail, or Australian, I think even retail, started sending crypto, which is non-refundable, to this plus token Ponzi scheme. And so they were accumulating, and then throughout Q4 2019, as is suggested by research from ErgoBTC and a few others, this is from Chainalysis, but all these people came to the same conclusion. There was a massive mixing attempt on a mixer for BTC. It kind of failed, it got stuck, and those coins were easily tracked. And so we can see all this happening on Huobi. There was selling pressure right before the massive down move in September, October. And there was another massive down move post-China news in November. So they definitely waited, they being the plus token people, waited to sell until that pop on the China news. And you can see pretty directly why we didn't have bullish continuation post-China news as the selling ramped up. The selling was basically equivalent to double the Bitcoin block reward, which is a pretty significant daily selling pressure, supply pressure on the market, especially at prices above 10K or around 10K. It's definitely better if there's more token dumping or coin dumping at lower prices, because the market can absorb that a lot better from a notional perspective. Whereas if we're dumping 34 million, when Bitcoin's at 10,000 versus the 34 million equivalent when Bitcoin is much cheaper, it's easier to actually absorb that into the market. There was a lot of concern about Bitcoin's hash rate, the hash rate volatility throughout Q4. Looking from October on, you can see how volatile this was. Difficulty was actually pretty volatile in both directions early on in November, but then it sort of peaked out, plateaued. And now going into January and February, we're seeing, again, all-time highs in hash rate, all-time highs in difficulty, greater than a 5% adjustment in difficulty. So this just says that miners are definitely not scaling back. They're scaling up pretty significantly. As hash rate increases, difficulty will increase as well, which means it's harder to mine BTC at a profit for most of the smaller guys, the bigger guys as well, but the smaller guys are really hit the hardest. And all the proof of work coins, aside from ETH, basically saw all-time high in hash rate in 2019, which is either an ASIC technological thing or crypto mining thing, just collectively. Now, if we look at LTC, it peaked in July, basically pre-halving. Its halving was in August, block reward halving. And since then, hash rate dropped off 70% plus. And this is a concern if you extrapolate this to Bitcoin halving, if there's a massive run-up, which is happening currently in hash rate and potentially in price, that we'd see this massive miner capitulation. This is what miner capitulation looks like. Miner capitulation does not look like random volatility, day-to-day intra-volatility in hash rate. We really don't know exactly what hash rate is at any given point for Bitcoin, but difficulty is able to snapshot, what hash rate is on that day, every 2,500 blocks or whatever it is. The same thing for LTC. The LTC, clearly difficulty is dropping substantially here since the halving. Talking about stablecoins a little bit, it's pretty clear based on most metrics that you're going to look at that the blue here, the USDT on ERC20, is significantly dominating everything else. The only reason it's not dominating the average transaction values is because there's so many transactions that really brings down the average. Whereas for USDC, there's much fewer transactions. The transactions are bigger. Another thing you can extrapolate from this is that traders and people using stablecoins will continually search for the cheapest and fastest way to send things, which is one reason why Omni has fallen out of favor. It's slower and more expensive than ERC20. Now, what I don't have on here is the Tron USDT. I don't have Liquid on here, like Liquid USDT. USDT is sort of spread out now to many, many chains. The chain that is able to provide the quickest and cheapest method of transfer will, at the end of the day, be the winner, because from a user perspective, you don't care when you're sending from exchange to exchange how it gets there. If I'm using Visa, I don't care what the transfer time is, right? For me, I just want to get it from point A to point B. So if I'm using USDT and I want to get it from point A to point B, I don't care which channel I use, as long as it's the cheapest and fastest. And so as long as exchanges continue to adopt new avenues for USDT, we're going to see this competition between Liquid, ERC20, Tron, EOS, all these chains, and eventually one's just going to win out, and you're going to see this picture where USDT is just going to be dominated on one chain just because it makes more sense economically. Another thing you can sort of extrapolate from this is that Gemini USD has sort of clearly, the biggest loser here in pretty much every metric. Daily trading volume doesn't even register as far as a percentage of the total on the data here. Switching gears to the token sales on ETH or ICOs on ETH, you can see pretty clearly that, I was talking about the July 2018 was the last time we had alt season. Correlates very well with the first month-over-month decline and continued bleed of money raised and sales ending. I don't think this is going to perk up anytime soon, even if you talk about security tokens or IEOs, which are ICOs on exchanges. I think for now, from a regulatory perspective especially, ICOs, IEOs, security sales, all those are sort of gone by the wayside for now, until there's some global regulatory clarity around who can sell what, when, and to who. These sales are just going to be essentially private deals between VCs. They're not going to be these open public raises that we had from 2016, 2017, 2018. That's just not going to happen again. Then lastly, looking at the ETH ICO treasuries, this is a question as far as what's the selling pressure for ETH going forward. Similar to the plus token selling. There are ICOs which have decided that they'd rather hold ETH than sell it to cash, which is a treasury decision. That's fine. But at the end of the day, that treasury represents potential selling pressure for the ETH price. So as long as these ICOs continue to hold millions of ETH, that selling pressure will continue to be there on the back burner, lurking, and you'll see the selling pressure ramp up at extremes. So when prices at a high extreme, you'll see lots of selling, people cashing out. You'll see lots of fear at the bottom of prices as these ICOs start losing their treasury value. Like in Q4 2019, this is just a compounding effect on price drain or the selling pressure.